So guys, everyone, welcome. Last class before the exam. We'll talk about the exam after the break. One or two people may be straight. You can pull out your placards, that would be great. And needless to say, if you don't have it,
So do we have class next Wednesday?
So we're going to have the exam on Wednesday. Well, we're not. I have a sheet regarding the exam that has this for a smorgasbord of authors. We have Saturday, Monday morning, Wednesday morning. Yeah, 2 weeks from today. 3 different options. All right? Patrick, sounds good? Now I'll review this.
I'll do Saturday.
Excuse me?
I'll do Saturday.
All right, I think we have you down on Saturday. No, we don't have you down on Saturday. At the edge of.
Yeah, I'll do Saturday.
Okay. I'll go through, let me just spend a minute. Saturday morning, 8:45 downstairs, and then we're going to go up to the 9th floor. We have Jenny, Zal, Tina, Ishika, CJ, not here right now. Anthony, Mohammed, David, Patrick. Monday morning, 7 in the morning, here. Right here, I'm going to shoot my cell phone number over. CJ put his name down there. Visa, you have you down Monday morning. And then 2 weeks from today, Yoni, Dill we'll talk about, and CJ and Adrian. All right?
Okay, so we meet here in this room? We meet here at 7 o'clock in this room?
Not in this room. I'll give you my cell number and I'll call you up and we'll figure out. Probably in the 9th floor, but the doors will be locked, so I gotta come down to meet you. Right, this way you get done before work, and that's good. Good?
So I think Wednesday for me. I'm not
Right,
on
you need. So 2 weeks from today.
Thank you.
All right? Hopefully with these 3 options, and I'll shoot an email, again, to repeat. Saturday morning, 8:45 a.m. Here, a week from this Saturday. Not this Saturday, a week from Saturday. Monday, it's a week from this Monday, and 2 weeks from today. All right?
Yep.
Hopefully this puts you guys in optimal position to show how well you know the course material. So at least that's my aspiration. We'll see if you guys hopefully can deliver. All right? All right. Let's review what we've covered to date and what we're covering today. Let me just make sure my phone is off because life is such that I ran down here. Yep, good news. So, to date, just quickly, because I want to make sure we don't rush through the material today. We have what entities are subject to tax. We know what it is estate, what is a trust. Chapter 2 are the basics, and when I say some of the basics, sorry for my repetition, pages 56, 57, 58. Again, each time we go through it, each week, including this week, should be that much easier to look through Manufacturers Hanover and get a good grasp of that material and what does mean fiduciary accounting income, because we know that's defined under the Uniform Code in the back of our textbook, right? It's not from the Internal Revenue Code, right? It's in the back of the book. What is gross income? And we have this concept of tentative taxable income. What is tentative taxable income? Is, if you recall, that will be the starting point to figure out what is D&I. Once we figure out D&I, remember, was critical, I forget it, was it Jill or someone else mentioned last week, not just what is D&I, then you must back out the tax exempt income and then figure out what is the modified D&I or income distribution deduction, right? Because why do we need D&I to include tax exempt income? To because you know that when we do the inclusion sections under 652 and 662, we have to know what is the amount of tax exempt income comprises the person's distribution, right? So that's all part of the DUI. But we can't get a double deduction, so that's why ultimately it's the income distribution deduction that's critical. That's the last line on a Schedule B. And that enables us, hopefully, to figure out the taxable income. Try to put together the exam. Let me remind people, I will not ask to compute the tax on the individual. I will not ask the person, any of you, to compute what is the tax due and owing to the trust. What I will ask, for example, is what is the trust taxable income, right? Just like we saw, the final line on page 59. What is the trust taxable income? But again, you're not going to have to take that number and tell me what is the tax due, okay? So fear not, you're not going to have to do that. And the converse is true, is that I think it's fair game for me to ask, what is the beneficiary's taxable income? But I'll stop there. I'm not going to ask you to compute a tax amount based on their, marginal tax rates or anything like that. So you don't have to worry about that. And notwithstanding some of the samples, the two examples I distributed last week, or the 2 prior weeks, and I'm going to distribute 2 more examples tonight. And you saw that the computer does AMT computations. I know I speak for all of you in your disappointment that you're not going to see any AMT questions, okay? I know. A lot of disappointment out there. All right, so notice no AMT issues, all right? I'll keep going with my summary, but just to remind people, again, this crowd, you guys, I think this will be the last time, but never say, in my case, the last time. If you're not doing anything, 2 weeks from this Saturday, that's not the day of the exam, okay? That's a week before.
22nd.
22nd. If you've never, and I apologize. Did I ask last time, has anyone ever been to a murder mystery? None of you. All right? You can make this your first. But you did get my email, putting aside that maybe you can't go. But, all right, so if you can make it, that'd be terrific. I think we're up to like 45, 50 people, so should be fun. But there's always room for more. And then I'd be remiss in my duties if we didn't talk a little bit about the taxes and going on in the 2016 campaign. I did send an email out to my income tax classes regarding the fact, just bear in mind, this whole controversy surrounds not Code Section 1211, dealing with the capital loss limitation rules, but it deals with Code Section 172. And some of you, I suspect, because it's in your blood, checked out Code Section 172 and you said, gee, did all the newspapers get it wrong? Because if you look at current Code Section 172, it talks about a 2-year carryback, right, and a 20-year carry forward. So you might have scratched your chin or your head and said, gee, why are all these newspapers talking about an 18-year period, right? That everyone's got 18 years.
Right.
And the reason, Patrick?
So 20 minus 2.
They
Now
get,
what they're doing, they're subtracting the 2 years back from the 20 years forward.
no, it's that was the prior law.
Oh, okay.
So prior law used to be 3 years back, 15 years forward, and now Congress, to raise revenue, tricky Congress, politicians kick the can down. Remember, there's less revenue. When they had to raise revenue, they made it a 2-year carryback, not 3 years, and this caused revenue to increase. If you get what happened, so we'll let the future politicians deal with the 20-year carry forward. So if you were looking and trying to figure out what was going on, did all these people blow it? No, that was legislative change. In 1995, that was the law. Okay? By the way, if any of you get the Times, the woman who got the package, Suzanne Craig, She wrote a little article about how she found this in her mailbox, the 1995 tax return in a brown paper envelope with a return address just marked the Trump Towers. She said, by the way, she ended the article, if anyone has additional Trump returns, here's my address, please send it. I check my snail mail regularly. Well, let me just tell you, I put a package upstairs to send it. Now, don't worry or don't think I have other tax returns. But I do have an article I wrote about the difference between Code Section 1245, which many of you may recall. 1245 is ordinary recapture income, right? Ordinary recapture income is taxed at what? 39.6%, right? Real estate investors, instead of 1245, what code section do they confront? 1250. What's the maximum tax rate there? 25. So I said, dear Suzanne, you may or may not realize, you and your readers, that aside from the NOLs, there's this provision where essentially real estate investors get this tremendous discount. That is, the average taxpayer pays 40%, real estate investors only pay 25%. So we'll see if that whets her interest. I'll keep you posted if my brown paper, I purposely put it in a brown envelope, not the tie back green and white. I figured this may get her attention. We'll see. Any commentary from you guys about Trump's returns? Anything that strikes your fancy? Nothing?
I don't see how it's so lucrative to lose $1 billion and losses.
Well, it's kind of interesting that he apparently wasn't subject to the 469 passive activity loss limitation rules as a real estate professional.
Yes.
Is that what you're doing? No, you're just
No.
stretches. All right, back to teenagers. Go
As someone who
ahead.
does a lot of real estate professional work, and granted the laws are different than they were in 1995, I can't tell you what they were.
Right.
Because you've seen my transfer, you've seen my data, you know how old I am. But it didn't really faze me all that much. I work on a lot of rich people who don't pay $1 in tax because the real estate laws, they let them take so much depreciation now that it's not really
Right.
I wasn't
No,
I wasn't overly surprised at it.
I mean, he truly was entitled, presumably, if he had that economic loss. I mean, it's not like I fault him.
Right.
I wouldn't call it a fiduciary duty. I think that is a stretch.
Yeah.
But, hey, you have that kind of loss, you should use Code Section 172.
But Professor, is there a specific reason real estate investors are taxed at a lower rate than?
It's called lobbying. And this country culturally has a fixation with ownership, real estate ownership.
Yeah,
You look at home ownership in Code Section 121, right? Need I say more?
Yeah.
So it's in our blood. All right. So we went through these problems, and again, we're going to go through more. I want to make you guys well versed in this. We saw about how Code Section 212 expenses, insofar as they relate to tax exempt income, that a portion is allowed and disallowed. Generally, a very simple fraction of tax exempt income over overall income, right? There's some, if it's over a longer period of time, it may differ. You may have to build in for unrealized gains and realized gains and things like that we saw under FABIS. But generally that fraction, everyone's familiar with it. Again, I say this in a way, the better you do, the better I feel. So I don't mind putting it out there. Anticipate some, not all, of the problems will have some, these are right tax exempt income. So that at least everyone here should know that some, right, Tina, those expenses will be disallowed because some of those expenses will be allocable to the tax exempt income. Right? And what's my authority? Manufacturers Hanover in the series of cases the authors present us with. Right? Right? We talked about the personal exemption of 100, 300, and 600. We talked about the Code Section 642C, charitable deduction, depreciation and depletion, and sort of follow the money trail, and wherever the money goes, that's where the depreciation and depletion goes. One other, guys, tax bill is my world, so I can't resist pointing out to you. I think New Jersey votes to increase the gas tax on Friday. Everyone agree?
Yep.
That's the latest. But to me, the more interesting part, at least for my world, is that simultaneously with that, New Jersey will join the ranks of 31 other states, and soon we'll have no estate tax.
Estate tax, yeah.
Okay, so that's going to be an interesting dynamic in this state. For the first time that I know, New Jersey will not have its own estate tax. So just as you go out and practice, that's going to be phased in, but it sounds, if I read the reports correctly, effective in the year 2018. So this year we'll have the normal rules. Next year, I think it goes up to 2 million, and 1 year later, poof, it's gone. And you know the sales tax is going to be slightly reduced.
6.875, something like that.
Notwithstanding that this is supposed to make our roads better, the solvency of the state is now cast into deeper red because that comes at a big price tag to reduce the sales tax even by that. So,
New Jersey had, I think, the fourth lowest taxes on gas.
well, that's ridiculous. I know. Don't get me started. But
Yeah, it doesn't make sense to me.
I know some people like the cheap gas in this room, or your parents do, or your friends do. But right around some of the bridges, have you guys, I think, is it the Goethals Bridge is the one that connects us to Staten Island?
Yes.
Doesn't that bridge feel like it was built in like the 1930s?
Well, Professor, have you driven over the 109 bridge
Yeah.
right on the Hackensack River?
I think I know which one.
Or if you've taken the PATH train, that's the best. When you are in the train looking at the bridge, I'm afraid to drive on that bridge. Seriously.
Is it? Okay.
Yeah.
I mean, you know, I always thought the Tappan Zee Bridge to me was a very good bridge.
Right.
And that one's being replaced where bridges that you look at and it looks like it's crumbling. I can't figure out, I'm not, you know, ask me a tax question. All right. Passive activity rules, we saw how they apply to trust. Chapter 3, pivotal. Why is it so pivotal?
Yeah.
Because it is what distinguishes trust and estates from all other entities. Why? This whole concept of D&I and distribution deduction, which is not at all like what happens in the context of a partnership, S corporation or corporation, right? So important, this is the kind of thing you have to leave and take away with you. The first part of the chapter looks at Code Section 102 just generically, which is something we all covered in income tax classes, and this notion that generally the receipt of gift of request is not subject to tax, okay? The income on it is 102B, and all of subchapter J is an extension of that concept. All of subchapter J is an extension of that concept. The authors give us a quick case to show us, in the Harkness case, you know, this is there for historical reasons, why tracing is no longer how things go, that we have this concept of D&I that erases this notion that predated the 1954 code. We have D&I beginning on page 123, and we know that Code Section 643 defines it. We have, I used to call them the new regulations, they're not so new anymore. And these regulations emphasize the flexibility. They're more flexible than their predecessors. The big takeaway, again, I'm hoping you remember a lot from this course, but I know some of you may not regularly practice in this area. Having said that, the big takeaway in most instances, but again, not all, that D&I does not include capital gains, right? D&I does not generally include capital gains, but that is not an edict. That is not something that is always true with the capital A, okay? Sometimes it does. The regulations enumerate several circumstances when it might, all right? then, so the authors then describe some of those exceptions, and we saw them in classes, we saw them. And I said to you, the regulations offer, I think it's 14 examples. Some of these cases are hard to read. I think the examples, the authors, when I say the authors, the Treasury Department offers, the 14 examples are fairly straightforward. Go through them. If you have a problem, shoot me an email. I'll be around for the next, I'm not going anywhere until December, okay? I will share with you the place where I'm going in December actually was on the front page of the New York Times Magazine section last week. So I took a look and I said, whoa, it's there. Where I think I tell you where I'm going in December. Very excited. I'm going to Ethiopia. I'm going to the I don't know if I'm going to pronounce this correctly. The Danakil Desert, which is supposedly the hottest place on the planet, and you can only go there during December, January, and February. But because of the volcanic ash and whatnot, a lot of the ground is multicolored. So on the front page of the magazine section, it had this person sitting on like what looked like a rainbow on the ground. It was kind of cool because of just the way the stone's mineralized because of the heat and ash. So I'll let you know if it's as cool as the New York Times says it is. All right. So anyway, my point, I'm going to be here. So if you guys have questions or issues, get in touch with me. All right? Use me. Distributions to beneficiaries. We covered this. Is now, I think I asked you at the beginning of last class, or Patrick, about simple trust code sections are?
651 and 652.
And what does 651 provide?
Expenses?
Deductions.
Deductions.
And 652?
Income?
Inclusion.
Inclusion.
And then Patrick, complex?
41 and 42.
No. CJ, which is it?
661.
661, come on. Yeah, 661, 662.
Yeah.
Same thing.
Yeah.
661 for deductions, 662 for deductions, right?
Yeah.
Right? Again, it's an open book exam. You don't, you can bring whatever you want in terms of extra material, but it's useful to know where things are located so it doesn't become a research project, which you may not probably have time for. So the beneficiaries, to the extent there's D&I, will pick it up. That will be the ceiling amount. Last class, we went into detail of simple trusts. Simple trusts are those trusts, right, required to pay out all income, make no principal distributions, nor are there any distributions made to charity, right? And we said it could be a simple trust 1 year, it can be a complex trust another. We also made the observation that all estates are complex. And that's where we left off. Any questions to date? And our goal today, guys, essentially is to make sure to go through complex trust. What are complex trusts? And by going through complex trusts, you'll see it reinforces, I like it you to see, reinforces what are simple trusts, right? It should serve that role. And then I do want to talk to you something I mentioned in prior classes about specific requests, code section 663. And we will, I know, Dill, you want to talk about separate trusts, okay? So that's all part of this. All right, so for separate shareholders. Any questions? Logistically, everyone knows about the exam, CJ. Complex trust. Now, if you could, open up your book to page 178, and if you could, open your code to code section 661, okay? So if you can open up code to your booking code, that'd be great. And I'll just share with you, unfortunately, Eric decided he couldn't take this course anymore because of the situation at work. So if you're wondering where Eric disappeared to, work-related issues led him just had to keep his job, let's put it that way. So if you look at page 178, There's a lot packed in, pages 178 and 179, I have to tell you. So I think it's worth it. I don't love or relish revealing things straight from the book, but in this particular instance, let's just go through this and then see if everyone understands it. So on page 178, the authors make the observation that if you're not a simple trust, by default, you're a complex trust. These are trusts that are generally authorized to accumulate income, and generally, as we already pointed out, since estates generally don't mandate the payment of income, they're all estates are subject to tax under 661 and 662. And the authors first try to draw a distinction between, writes out, right, Patrick, between simple and complex trusts. Under, each one has its own analog between 651 and 661 and 652 and 662, right? Two different analogs. So it says under 661 and 662, there are tiers of beneficiaries. Okay, so this is important. This is what you have to get down. There are two tiers, right? First tier beneficiaries are those, if any, to whom income is required to be distributed currently. Right? First tier. And not surprisingly, to the extent there's D&I, guys, to the extent there is D&I, these beneficiaries, the first tier beneficiaries, will pull it out. Anyone else? Here's the default beneficiaries, are called second tier beneficiaries. For others to whom the entity properly pays, credits, or distributes any amount. In essence, all beneficiaries other than mandatory income beneficiaries are second tier beneficiaries. It points out only if the entity has D&I in excess of current income required to be distributed is any of the entity's income allocated to the second tier. So often, the second tier may or may not have taxable income. There may or may not be D&I, right? And there may be no first tier beneficiaries. Let me just make that up. The authors make that observation, right? You can have a trust instrument that I give, devise, and bequeath $1 million in trust for the benefit of my children and pursuant to the following terms and conditions, and just have a sprinkling provision that says no, doesn't provide for any income to be distributed, right? Just provides that income will be sprinkled. So that in that instance, you can have first tier, you may have a situation with no first tier and only second tier. That can happen. The authors then go on to say first tier distributions qualify for the distribution deduction under 661A, and their beneficiaries are subject to tax under the analog of 662A1. These provisions work in the same fashion as 651 and 652, right? Everybody see? That's essentially a simple trust. Second tier distributions are 661A2 and 662A2. Under 661A2, a trustee is allowed to deduct amounts other than income required to be distributed that are quote-unquote properly paid. 662A2 subjects the beneficiary of any such trust to taxation. I'll add parenthetically, assuming there's adequate D&I. So, if you look in your code, you will see code section 661, A1 and A2, and I have labeled next to them, at least in my code, tier 1 and tier 2, just to make that observation. Similar to 651, it says 61B talks about the character. It's going to be the same character as the D&I. And 661C is that same limitation on deductions. That's the IDD, income distribution deduction, or modified D&I. The inclusion, notice it's done in that 662, A1 and A2, tier 1 and tier 2, right? Character is going to be the same as it was deducted, and the tax years are going to, remember, trust must be on a calendar year, taxpayer must be a calendar year taxpayer. Estates can be a fiscal year. Whatever year that estate ends, its year will be picked up for the taxpayer in that taxpayer's calendar year.
Trust.
Yes.
If the trust, or I guess the trustee has the discretion to distribute and decides not to,
Right.
they're still, I mean, hold on. That beneficiary that they get, that's a tier 2 beneficiary, right? Because
They may be in tier 2, but they're not getting anything,
Right.
so the income will be remain taxable to
at the trust, right, okay. I just, yeah, that's all, labeling issue, that's all.
So, just some quick things, and then we're gonna see examples of this. So, I'm gonna say one thing, and then you're gonna hopefully be able to apply this. So, suppose you have D&I, which is less than the tier 1 distributions, okay? So, you have tier 1, the distributions are greater than D&I. So suppose D&I is 10,000, and you have tier 1, tier 2. A, B, and C. 4,000, 4,000, 4,000, and 10,000, okay? How much would A, B, and C be taxed? Rashida, what do you think? And Tina, see if you agree. What do you think? Rashida, what do you think? You're whispering. Just how much would A, B, and C each be taxed? On what number? Not sure? Tina? Just say it, you're whispering. 4,000 each? Did I hear you right? Brett, you agree?
No.
What do you say?
10,000. Isn't it limited to the equivalent of the?
So how much would A, B, and C be
10,000.
taxed?
10,000.
But they can't be at 10,000 each?
No, total.
So that means they'd be taxed in how much?
3.33. Yeah, exactly.
$3,333.33?
Yeah.
Yes. Right? They each fill out a proportionate share at D&I, and everything else comes in tax-free, including A's tier 2 distribution would be tax-free.
It's only 4,000 each on their distribution.
Patrick, say what?
I think they will be taxed on the amount of the distribution, which is 4,000.
4,000.
Because it's lower than the total DNI.
So your final answer is A gets taxed on how much? B gets taxed on how much?
4.
These agree, disagree. That's sure, Jenny?
Yeah, utilized all tier 1 for 3/4, and the tier 2 utilized A.
So that's a different answer.
Oh.
Oh.
Oh!
No, I didn't mean the tier 1 plus the.
Well, it's right here. You don't have to read that. You can just look here.
Yeah, well, it'll be the same.
Patrick.
3,333.
All right.
Yeah.
Tier 1, there's plenty of D&I to cover all of it, right? Everyone agree?
Nice.
So all 4,000 to each would be taxable. How much D&I is left?
8,000.
8,000.
Right.
Right? So of the 10, A would be taxed on 8, but 4 plus 8 equals 12, right?
Right.
All right. You gotta say that, Patrick. You know, and then obviously if I made this 25, you guys know the answer, right? Adrian? How much would A, B, and C tax?
4,000.
Is that your final answer, Zal? Would you refine that?
I stayed in there.
That's sure. Rashida, did you get this?
30,000.
Just say again.
30,000
How much would you tax?
for car 1 is 4,000 each.
Right?
And for second, it will be 30.
What number?
30.
13? Where'd you get that? Man, don't overcomplicate it, guys. There's 25,000 of D&I. Oh, hon, I know what you did, Rashida. You took the 25 less 12 and you got 13.
So it's gonna be
But that
10,
just
I
means
guess.
that there's plenty,
Yeah.
that just means there's 13 D&I remaining, plenty to cover the 10.
So just 10.
Yeah. So it would be taxed on 14. Right, Adrian?
Yeah, I mean, tier 1, 4,000 each, and tier 2.
Did you say, I apologize, did you say tier 2 that he was going to be taxed on?
Well, I didn't get to tier 2 because you cut me off.
Oh, I didn't mean to. I didn't mean to cut you off. You should just step right, like the vice presidential debate. You should have been like Keenan and just cut me off. They said he was over caffeinated. And you know what? Maybe I'm over caffeinated, so I apologize. Shita, okay, but, Rashita, you understand that there's, the D&I cup runneth over here. Plenty to cover the tier 1. Once you cover that, whatever remains can cover the tier 2, but don't change the numerical outcome. CJ.
So when it was 20,000 DNI, it was 4 plus 8 for 8? 4 from tier 1 and 8 from tier 2?
No, 12 from tier 1.
No, I mean for just for 8.
Hey, yeah, 4
Plus
and then 8.
Okay.
Right? And again, I anticipate asking you some questions on this on next week or whenever you're going to take the exam. Can you cover, and not hard questions, you know, what is tier 1? You know, here's same sort of concept. Does everyone get this? Tier 1 comes out, which is not a good thing. This is a race you don't want to win insofar as, to the extent you get D&I, that's going to probably pull out taxable income. To the extent there's not D&I, right, the distribution is not taxable, right? Consider a distribution of principal. I have a few more examples along that line. But hopefully you guys get this concept. The authors then offer us a revenue ruling, 67-117. And here, the distribution, usually a stock dividend, you guys may or may not recall, from corporate tax code section 305A, says that a stock dividend generally not taxable. And there's a basis adjustment under code section 307. Remember back from corporate tax. So, and then 305B has a bunch of exceptions. But suppose you have a non-taxable stock dividend. Under the peculiarities of this state law, that's considered income for under the Principal and Income Act, which would be strange. So picture, if you will, you get a stock dividend, and that's considered income. But does that increase D&I? You get a non-taxable stock dividend?
No.
No, I mean, it's not going to, ultimately, there's going to be, okay. And the question is, under those circumstances, you get a distribution. What is its effect? And they give you 4 different scenarios, right? You can read these for yourself. They're not complicated to understand. We're going to get to this towards the end of class, but for the moment, I just want to call something to your attention. I called to your attention last week. I'll call to your attention now. I'll call to your attention towards the end of this class. Look at code section 663A. It says, any amount which under the terms of the governing instrument is properly paid or credited as a gift or bequest of a specific sum of money for a specific property in which is paid or credited all at once or not more than 3 installments. And those kind of payments are not going to pull out D&I. In other words, those are not going to be where if you get a distribution from an estate or trust and it's a specific sum of money, right? Someone's will says, I give you $100,000. And even if the estate has lots of income, it is not part of code section 661 and 662. It does not pull out, even though normally you think distributions made from an estate, generally the larger the distribution, the larger the D&I it pulls out. That's not true here, right? It is not true that with respect to these, they're not on the radar screen. And I'll give you a few examples. But this is towards the end of the class, but the authors in the illustrated material, the authors call attention to this. That's on page 181, item 3. Do not worry, you will not see it on any exam, I promise you. On page 182, there's a discussion of non-citizen and what are the effects. If and when you take international tax, we will certainly go into what are the tax consequences associated with being a non-citizen, but that's not the topic du jour. The separate share rule is spelled out in Code Section 663C. Let me just tell you that often, I think I told you that I create many trusts, and generally, and I think I follow industry protocol when I set up the trust. Generally, we set them up so that each beneficiary has their own trust. You might call it the Accountant Employment Act of the attorneys, because in other words, instead of having one pot trust in which one 1041 has to be filed, instead we will often say that, for example, on the demise of a surviving spouse, that there is created, the person has 5 children, and they create 5 separate trusts, and that there is not one pot trust. I don't know what you guys are used to. Does anyone here deal with any regularity with the separate share rule where there's a pot trust? I think it's a lot easier, even though there's 5 different tax returns to be filed. I think it's a lot easier for beneficiaries to know exactly what they have and what they don't have. And if you have one trust in which there's multiple beneficiaries and it's not entirely clear, even if there's quote-unquote a separate share of who's entitled to what. It's harder, I think, from a bookkeeping perspective. Anyway, having said that, so this is not something I come across regularly in practice, but take a look. I think the best thing to do to try to understand this, I put down as the key to mastery, Code Section 663, the regulations. The origin of this is 663C, which now extends not only to trust but also to estates, okay? That if you have more than one beneficiary, and depending on the terms of the trust, it's designed that each one is to have their own separate benefit from each, the trust. You're supposed to, for D&I purposes, treat it as 2 separate trusts. Now, it's one thing to say it, it's another thing to see what it looks like in action. So, if you could, if you look at the examples under the regulation 663C-5, I'm going to have that in the reg book 663C-5. Look at example 1. I think it's a nice illustration. A single trust was created in 1940 for the benefit of A, B, and C, where ages 6, 4, and 2. Under the terms of the instrument, the income is required to be divided into 3 equal shares. Each beneficiary's share of income is to be accumulated until he becomes age 21. When reaching 21, his share may thereafter be accumulated or distributed to him in the discretion of the trustee. The trustee also has discretion to invade corpus for the benefit of any beneficiary to the extent of his share of the trust estate, and the trust instrument requires the beneficiary's right to future income and corpus will be proportionally reduced. That's key. I have that sentence highlighted. Why do I have it highlighted? In other words, let me just make Yoni, Fisa, and Zhao the beneficiaries of this trust, okay? If that sentence was not there, let's just assume the trust had $900,000 in it, and the trustee, I'm going to be the trustee, and I decide Yoni should get $100,000. Fisa and Zhao would not be happy, right? Because Yoni just got $100,000, and if that sentence weren't there, on the termination of this trust, whatever remains would be split 1/3, 1/3, 1/3. Everyone agree? So Yoni would be a disproportionate beneficiary in those circumstances, okay, where there's a pot trust and I, as the trustee, can make discretionary distributions. However, with this sentence that says the trustee has discretion and the trust instrument requires the beneficiary's right to future income and corpus will be proportionally reduced, everyone understand that if he only gets $100,000 today, years later, he's going to get $100,000 less when the trust terminates, okay? So if he sends out, don't have to worry that, oh, my sibling Yoni got more than I did. Everyone got it? Everyone see that sentence? That sentence is key, Dale, since you raised the question, as a reflection that this is truly designed to be treated as separate shares. If this sentence weren't here, and it could result in disproportionality, that's one true benchmark, that there's no separate share.
Okay.
Separate share usually means it's designed to preserve whatever the testator had in mind as a percentage ownership. If that preservation is not going to be maintained, there is no separate share. Tina, how confused are you? Did you get that? Suppose I set up a trust for you and Harshita, okay? And I put in $1 million, 500, and I say 50-50. And Yoni's the trustee. And he can exercise, he can make whatever distributions he wants to you and to Harshita. If he makes distributions to you and there's no recalibration to take that into account when the trust is terminated and final distributions have to be made, you're going to end up with work, right? Then Harshita would, right? So that's not treating it as if there were two separate trusts. But if there's a provision in there that says whatever you get will be that much less you'll get when the final distributions are made, that's a significant sign that I intended that you and Harshita will get exactly 50-50. I could have said you get 20% and Harshita gets 80%. Same thing, and a distribution is made by Yoni to you. But at the end of the day, the intention is there an intention that you absolutely get 20% of the trust and its corpus over the, say, 10-year term, and Harshita gets 80%. So whatever those percentages are, is the intention to preserve and maintain them. That's separate share. If there is no such intention, there is no separate share. If there's two separate trusts. So, it says when each beneficiary reaches 35, the trust estate will be paid over to him. The interest in the trust estate of any beneficiary dying without issue before he has attained age 35 is to be divided equally. Okay, then it says no distributions of income or corpus were made by the trustee prior to 1955. Although A became 21 on June 30th, 1954, during the taxable year 1955, the trust has income and royalties of the following. And makes the trustee in his discretion distributes $12,000 to A. Okay? And the question is, with this $12,000 distribution, it says the trust qualifies for the separate share under 663C, and the D&I must be divided into 3 parts for the purpose of determining the amount deductible in the trust by the trust under section 661 and the amount includable in 662. The D&I for each share of the trust is $5,000. Okay, in this case, again, there's 3 different beneficiaries. Since the amount distributed to A during 1955 exceeds D&I, that's, again, that's of each share. Okay, even though the total D&I is $15,000, and normally that would be enough to cover all A's distribution. Since this is considered as 3 separate trusts, you have to take that D&I and divide it into 3. As if there were 3 separate trusts. Okay, so the separate share rule, depending on how many shares of trust you have, and if there's a 20-80 breakdown, you have to give 20% to one trust and 80% to the other trust. And then examine what is the size of any of the distribution being made. Since the amount $12,000 distributed to A during 1955 exceeds the D&I of $5,000 allocated to share, the trust is deemed to have distributed him $5,000 in 1955 income and $7,000 of principal. So even though the trust made a $12,000 distribution, it's only going to get a $5,000 deduction. And 5 little I says, in accordance with 662, A must include in his gross income for 1955 an amount equal to the portion of $5,000 of the D&I which is allocable to his share. And don't worry about the second part where it says the excess or $7,000, just put as principal. Don't worry about the throwback rules. The throwback rules have been repealed, so that last sentence is not applicable to us. One more example. I want to draw this example too, and then we'll move on. We have testator died in 2000, survived by wife and 2 children. Testator's will contains a fractional share that is dividing the residuary estate between the surviving spouse and the trust for the benefit of the children. Under the fractional share, the marital bequest constitutes 60% of the estate, and the children's share is 40%. And here, the executor makes a partial distribution of $1 million, 60% to the surviving spouse, 40% to the children. And the estate receives dividends of $20,000 and pays expenses of $8,000. Conclusion: the fractional share formula bequest to the surviving spouse and children are considered separate shares. Okay, because in this case, each one is deemed to have a different percentage of ultimately the estate. Okay? When the estate is divvied up, ultimately it doesn't matter the interim distributions, but at the end of the day, each side has a right. Whatever that estate ends up being, with its appreciation and income earned, has a right to 60-40. And you can read the rest for yourself. Go through these examples. They're not hard to follow, guys. If you don't mind me saying, and I'll say it, the examples under the regulations are much simpler than the revenue ruling. For example, the authors give us 74-299. That's a hard revenue ruling to read. So if you get a chance, your time is much better spent reading the simple examples rather than the somewhat obtuse revenue rule. I think the authors included the private letter ruling, 2006. It's a nice, simple, straightforward illustration, I think, of how this, of the separate share rule. It gives a nice little law analysis, and on page 186, cites the regulations that this would be a separate share. All right, so it's not going to be something that you're going to be able to quote at the barbecue, but it's a nice, easy read. So once you read the examples under the regulations, take a look at this private letter ruling. What I'd like to do is give 2 different problems. Let's look at one now and one later. The first one, I'll do the second one. I'll do the first one dealing with a complex trust. This problem 4. And then after we go through the problems, we'll talk about estates. And I have another example to distribute, so if we could just pass these down. think one more, that's what I was. So after the break, we'll go through an estate, but let's just do one, and then we'll do the examples, because I think, again, it's useful to see what this looks like in an actual tax return, and then we'll see simplified versions of this when we go through the problem. So problem 4 is complex trust. What does it mean? It's not a simple trust, which means there's no mandate that income be paid out, right? So we have to see if there's tier 1 and tier distributions. Good news for your team, makes life easy. There's no tax exempt income, right? So we don't have to worry about the manufacturer's Hanover case. Everyone's smiling. There is capital gain distribution present. Also short-term capital loss and long-term capital gain allocated to the trust. Investment advisory fees present. So what does this mean in terms of, we have certain expenses, right? Property taxes, fiduciary fees, professional fees, investment advisory fees. There is the 2% floor on the investment advisory fee. That's something we, statutorily now is in the code. Don't worry about the AMT issue. Let's go page 1 of the Form 1041. Notice on the page 1 of the 1041 on the upper left, notice the box checked off. So we went from simple trust now, guys, to complex trust, right? That was easy. And interest income, no surprise, 20,000. Dividend income, 25,000. Capital gain, we're going to net the capital gain distribution, the long-term capital gain, and the short-term capital loss. So we're going to get a capital gain there of $8,000. What's our tax total income? $53,000. Everyone see that? Okay, let's go for some deductions, right? Always good, always nice. So we were told that the property tax is $8,000, fiduciary fees $6,000, attorney's fees, accounting fees $5,000, professional fees. Now because this so-called 2% floor, the investment advisory fee got a haircut. Everyone see that? So our deductions here are $24,327. That's our, leaving us with the adjusted total income, $28,673. Everyone see that? Where's that going to go? It's going to start right on the top of the page. The next page, Schedule B. Everyone see that? Now we got to get rid of the capital gain. Everyone agree? Which we do.
Yep.
Everyone see that we got rid of that? Now, here, there's required Tier 1 distribution of 8,000. $8,269. Now, the that's going to be our distribution. The tentative taxable deduction is going to be that amount. And you're going to take whatever is the lesser of the let me just confirm this, that what was being distributed here was the $8,269. And that number is going to end up from line 15 of the Schedule B, that ends up back on the first page. That's going to end up on line 18. That's going to be your distribution deduction. Our exemption is $100. What ends up happening here, guys, not surprisingly, is that we know that not only is the trust going to be taxable on the capital gains, right, that's not going to be part of D&I, but it's also going to be taxable. There's money that's going to be retained here. So the taxable income here on line 22 is not what it was on the simple trust. It's $20,304 when you subtract out the distribution deduction. And you take out the, notice guys, it's 100 rather than 300 is the personal exemption. All right, so, and let me just call to your attention, the K1 here. Take a look at the back end of the K1. That's a composite, the interest income and the ordinary dividends, or in this case, they're qualified dividends. That's a composite of $8,269, and trying to let me during the break, I will during the break, I figured out exactly how the expenses were allocated, but I have my own notes here that, let me just during the break figure out how I got to the expenses. So let me do this, guys. I just want to give you a taste of what where a complex trust, you're not going to see anything like this on the exam, but just where things end up on the return. In the interest of time, let me just go through on page 186. Let me just talk to you about some of these problems, and then we'll get back to the example I have, and I'll work through some more of the numbers. 3-16, let's go through things that more likely you'll see on the exam. On page page 186, column 3-16, we have a testamentary trust is required to distribute all of its income currently to the testator's wife. However, the trustee is authorized to pay principal to one or both of the testator's wife and son. Okay, notice, by the way, let me just call to your attention that virtually every so-called marital trust under Code Section 2056 has to qualify for what's called the federal estate tax. You're not responsible for this, but something called the federal estate tax marital deduction. Income must be paid to a surviving spouse. So it's very common for any trust for the benefit of a surviving spouse to mandate the payment of income. Anyways, it's required to distribute all the income currently to the testator's wife. However, the trustee is authorized to pay principal to one or both of the testator's wife and son. In the year in which both D&I and fiduciary accounting income in the trust equal $50,000, the trustee distributes $50,000 to the testator's wife and $25,000 to the testator's son. None of the trust income is tax exempt. What are the tax consequences to the trust, the wife, and the son? So in this case, we have W and S. So in column A, we have D&I of how much?
50.
50. And we have total distributions, 50 and 75. So distributions equal 75,000, right? So how are these going to be divided up in tier 1 and tier 2? So in this case, 50. Let me just ask Lisa and Yoni, how would you divide this up? Who's tier 1 and who's tier 2? Lisa and Yoni?
Wife is tier 1.
The wife is tier 1, right? How much money is she getting? Required to get?
50.
50.
And who's tier 2?
The son.
So who's taxed on what? And then needs to see if you agree. Yoni, who's taxed on what?
The wife is taxed on 50. The son is taxed on 0.
And the son is taxed on 0. How about the trust?
0.
25.
Lisa?
Well, I agree the wife is taxed on 50.
Say it loudly.
I agree that the wife is taxed on 50.
50. How about the son? Any tax? 0 tax? Tax on 25? Say it loudly.
25.
Would be taxed on 25? Yeah?
Yeah,
Yeah, what?
25. I mean, no, I'm sorry, some of the tax on 0.
And the trust?
Trust is tax on 25.
Where are you guys getting the trust is taxed on 25? The trust has presumably income of 50. The wife's going to take it. Is there any income left to be taxed? So the wife here would be taxed on 50. The son on 0. He gets 25,000, but that's considered a distribution of principal, right? And the trust, there is no taxable income left, right? It's going to get a distribution.
Yes, that's the principle, yes.
Just be careful. Everyone got that?
Yes.
Question B. Same facts as 3-16, except the trust D&I is 65,000. This is A. B is 65,000. So, in this case, CJ, Rashida, Tina, what do you say?
So, wife is taxed on 50,000. The son on 15,000.
Trust,
Trust 0.
Rashida?
That's correct.
I'm sorry?
That's correct.
That's correct. Tina? Yes? Mohammed, you were gonna say something?
Yeah, trust would be taxable on 15,000,
Why?
because they're only allowed to distribute income to the wife.
Well, they're only allowed, but then he exercises his discretion and makes another distribution.
But only a principal, no?
Do we do tracing in this day? After 1954, no. And if it doesn't fall within the scope of Code Section 663 as a specific request, right, then it will pull out D&I. So that would be a Tier 2 distribution. So CJ's right. Wife tax on 50, son tax on 15, trust tax on 0. Three 18. Assume that the D&I is now 35. So, Adrian, Patrick, Anthony, what does he say here? Adrian?
I say wife 35, son 0.
And trust?
0.
Patrick?
I agree.
Anthony?
I agree.
So, even though wife and son each get, maybe I should use a different color. Now this one, this was 50 and 15, and this was 50 and 0. This is 35 and 0. Right? The blue representing what they were taxed on, right, Lisa? The amounts they were taxed on. Question 3-19. The trustee is authorized to sprinkle income and principal among the testator's wife and children. By the way, I'm just going to call to your attention because I feel Carol left it right in. 3-16, 17, and 18 would not qualify for the marital deduction, estate tax deduction. In other words, if you leave monies to your spouse in trust, if you have $1 million to leave it outright to him or her, there's an offsetting estate tax deduction, okay? But if you leave it in trust for that person, the only way you get a marital deduction if that trust is designed 100% for the benefit of the surviving spouse. If you can make distributions to a child, it does not qualify for the estate tax deduction. So I'm just calling that to your attention. That's a practical matter. All right. In 3-19, the trustee is authorized to sprinkle income and principal among the testator's wife and children. In a year in which both the D&I and fiduciary accounting income are $50,000, the trustee distributes $30,000 to the testator's wife and $20,000 to the testator's son. None of the trust income is tax exempt. What are the tax consequences to the wife, the trust, and the son? So question D, we have wife and son again. And the D&I in this case is 50. So in this case, Anthony, Brett, Mohammed, tier 1, tier 2, what would you do? Anthony, Brett, Mohammed, see if you agree.
Wife taxed on 30, son on 20.
Are these tier 1 or tier 2 distributions, Brett?
They're both tier 1.
Anthony, agree, disagree, Mohammed?
I think they're both tier 2. And the wife is 30 and the son is 20.
Are they both taxable or not?
Yeah.
Mohammed?
I agree tier 1,
What?
but I'd say tier 1, but
What information is in there that you would distinguish between tier 1 and tier 2? What are the
The cost,
keywords?
is there any income required to be distributed? And the answer is?
No.
No. If there's no income required to be distributed, they are tier 2 distributees, right guys?
Yes, sir.
And as such, I mean, in this case, there's plenty of D&I to cover that now. Well, plenty, enough. All right, everyone's got that? 3-21. Trustees authorized to distribute 1/2 of the trust income and 1/2 of the trust principal to the grantor's daughter. The other 1/2 to both, half of both. Sorry. Assume the same facts as 3-19, except the trustee and I is 30,000. I apologize. Wife, son, you know they're tier 2 distributees. So, in this case, these are Val, Jenny. Jenny, you want to see what you say? And Val, Lisa.
Wife 18, son 12, trust there.
18 and 12. Lisa?
I'm not sure.
I have the same.
Okay, why? Val.
Proportion,
I'm sorry?
the per annum, we use the separate share rule.
Is it really the separate share rule here? Isn't this under 661A2? And you're going to get a deduction of 30,000. And how much do you have to include? Let's look at 662, right? That's our inclusion section. Look at what it says. 662A2. If the sum of the amount of income for the taxable year required to be distributed currently to all beneficiaries, and all other amounts properly paid or credited are required to be distributed to all beneficiaries exceeds D&I, right? It does. And in lieu of the amount provided in the preceding sentence, there should be included gross income of the beneficiary, an amount which bears the same ratio as D&I as the other amounts properly paid, credited, or required to be distributed to the beneficiary compared to the other amounts probably. So what that means is you create a formula, not too complicated, but the formula is x is equal to D&I times other amounts distributed, other amounts to W over all other amounts.
X is taxable portion?
Yes. So this ends up being x is 30,000 times 30 over 50, and that ends up being 18. And obviously, for the son, we got 20, it'd be 20 over 50. D&I it should be constant, should be 30, I'm sorry. 30 times 20 over 50. So Jenny, I'm assuming you just took a ratio. Okay? Daisy, you got that? Which makes sense, right? They're both tier 2. Neither is coming before the other, right? All is equal. Both are equal, I should say. But remember, the larger the distribution, the more the D&I. She's pulling out 60%, he's pulling out 40%, right? In terms of size. And therefore, D&I and 30 has to be split proportionally, right, Tina? One more question, we'll take a break. The trustee is authorized to distribute 1/2 the trust income and 1/2 the trust principal to the grantor's daughter, the other 1/2 of both to the grantor's son. Upon the death of either child, 1/2 the principal is passed to his or her issue. In a year in which D&I is 10,000, the trust distributes 10,000 to the grantor's daughter, but nothing to the grantor's son. None of the trust income is tax exempt. What are the tax consequences to the trust, the daughter, and the son? Give us two different answers. First, assuming that the separate share rule applies, then assuming it does not. So we need two different answers here. Separate share, as you recall, is defined under Code Section 663C. And you could make an argument, it's not clear, the authors did this on purpose, obviously. They left it ambiguous whether or not the testator, the person who set up this trust, intended both the son and daughter essentially to be treated 50-50, or if disproportionate distributions could be made one, and there was no equalizing to the other. So let's assume for the moment that you set up these trusts for your son and daughter, and that you intended each one always to get an equal amount. And that if one got an earlier distribution, the other one would subsequently get an equalizing distribution, or on the final distribution. So in other words, if you apply the separate share rule, separate share, what would happen to the daughter, the son, and the trust? The daughter gets taxed, if at all, if there's a separate share, and how much, guys? Yep.
5,000.
5,000. Why?
Okay, she gets half. D&I.
Okay, it's treated as if there's two separate trusts. There's a total of 10 of D&I. Everyone agree?
Yes.
So what that would mean is take that 10, divide it in half, and her separate trust would have 5,000 at D&I, agreed?
Yes.
And how much is she taxed on? She's gonna be taxed on $5,000 because
She got.
under 662A2, that's all the D&I there is.
Yes.
So the daughter's taxed on 5,000, and there's a $5,000 deduction, right? You can never deduct more than the D&I, right? Even the modified D&I here happens to be 5,000 as well. So the trust gets a $5,000 deduction. Is the son taxed?
Son didn't get squat.
The son got squat. So therefore, 0. And the trust?
The other 5,000 less an exemption or two.
The trust would get taxed on 5,000 less, the exemption and all, right? Because, and essentially the son would ultimately bear indirectly the tax because his portion of the trust, this is where it gets funky from a bookkeeping perspective. When you have separate shares, that's why I prefer having actual separate trusts as opposed to trying to have bookkeeping entries. But the bottom line is the Form 1041 would reflect a trust with a taxable income of $5,000, right? Less, the exemption of your $100 or whatnot. Everyone good? Everyone see that? Now, take the converse. Suppose the shepherd share rule does not apply. The parent treated this as a one-pot trust and sort of got whatever you got and be happy for it. There's no equalizing distributions. In that case, what would happen here? To the daughter, son, and trust. Daughter, son, and trust. Bill, you're on a roll.
Daughter would get the 10,000 tax because she's treated as the sole beneficiary.
Yep.
The son still gets nothing, and the trust gets the $10,000 distribution deduction.
All right, here there's a Tier 2, 661A2 deduction. Daughter has a corresponding inclusion. The deduction is under 661A2. The inclusion is under 662A2. So you can see there's very different outcomes depending on whether or not there's deemed to be a separate share. And Tina, I don't know if you're getting a better sense now. What is a separate share? The intention underlying a separate share is that the settlor, there's one trust really intended, but multiple trusts, but theoretically for administrative ease, so there would only be one tax return. Had it all under one umbrella. But by the terms, I would have to spell out, or the terms of the trust would have to spell out exactly the intention that, the equalization between and among them. And that signifies separate shares, equalization. If there's no such equalization, then it's going to result in disproportionate, not separate shares. Yeah.
Yeah, so since the daughter received 5,000 this year, at the time the trust terminated.
She received 10,000. How much did she receive?
10,000, I'm sorry.
10,000, right?
Yeah, so at the time the trust is terminated, she's going to receive 10,000 less.
Is it a separate share?
On the separate share.
If there is, she should receive 10,000 less.
Oh.
If they're going to be considered 50-50.
Okay.
All right? All good? Let's do this. Oh, go ahead, Fiona.
Is there anything different with authorized to distribute as opposed to required to distribute?
Authorized to me connotes Tier 2. Required to be distributed depends if it's required to be distributed income or an annuity amount, that constitutes a Tier 1 distribution. So those are key words to think about. All right. why don't we take a break here, guys, and when we come back, we'll finish up these problems, we'll look at a few other things, and we'll call it a night.